Welcome to Talk Tickers. This is where we cut through the noise of the earnings calls, the financial reports, and that endless stream of market chatter to get down to the actual mechanics of the market.
It's good to be here.
Yeah, I'm your host, and if you've been on a trading desk as long as I have, going on 20 years now, you know that the flashy stuff, the high-frequency trading algorithms fighting for microseconds,
right?
That's just the surface. That is the tip of the iceberg that everyone sees in the movies. But the real story, the real risk, and frankly, the real opportunity is usually hidden in the plumbing. It's in the stuff nobody wants to talk about at cocktail parties.
You are absolutely right. I mean, we often look at the price on the screen, the ticker symbol flashing green or red, but we rarely ask how the money actually gets from point A to point B to settle that trade.
Exactly.
We assume it happens, like magic.
Oof.
But in finance, there is no magic. There is only operations.
Yeah. In the equity markets, we obsess over T+1 settlement. We fight for those microseconds. I mean, we have fiber optic cables drilled straight through mountains just to shave off a millisecond between Chicago and New York.
Oh, absolutely. The lengths they go to.
Right. Yet the actual movement of cash in the U.S. banking system, the pipes that actually settle the trades, pay the dividends, handle the payrolls, has historically moved at the speed of, a donkey cart.
A very heavily burdened donkey cart.
Yeah. We are talking about technology that, in spirit, hasn't changed much since the 1970s, but that is changing. We're finally, after decades of waiting, moving from a batch process world to a real-time gross settlement world.
It's massive.
And this isn't just about sending money to a friend for dinner. It's about how liquidity is managed across the entire financial system, 24 hours a day, 7 days a week, 365 days a year.
It is a fundamental shift in the architecture of money itself. We are moving from a system of deferred settlement, where we essentially promise to pay and settle up later, to immediate finality.
Right.
It changes the nature of credit, it changes the nature of risk, and honestly, it changes how every corporate treasurer in America has to sleep at night.
So today we are taking a deep dive into instant payment systems, and specifically, we are tearing apart the Federal Reserve's FedNow service.
That's good.
The big question we're tackling for you today is, how does the machinery of FedNow actually work under the hood? We aren't just reading the marketing brochure here.
No, we're looking at the operating procedures. We want to know what actually happens when you press the button.
And the follow-up question we have to answer is this thing going to kill the automated clearinghouse? Good old ACH.
It is the battle of the rails, old pipes versus new pipes. But as we will see, it's rarely a zero-sum game in this industry.
Quick standard disclaimer for you all before we jump in. This is for informational purposes only. We are dissecting market mechanics, not giving investment advice. Do your own diligence. All right, let's unpack this.
Let's dive in.
First off, we need to define our terms because instant payments gets thrown around a lot by marketing departments.
Oh, constantly.
You see it on ads for fintech apps, you see it in crypto all the time, but when we talk about FedNow, we are talking about something very specific. An interbank real-time gross settlement service, or RTGS.
Right.
Break that down for us. Real-time versus batch. What is the actual difference in the plumbing?
So to understand the difference, you really have to visualize the workflow. The traditional system, which is ACH, operates on a batch model.
Okay.
Imagine a bus at a bus stop. The bus represents a file of transactions. Throughout the day, people who represent individual payments line up at the bus stop. The bus doesn't leave just because one person is there.
It waits.
It waits. It waits until it's completely full of passengers or until a very specific scheduled departure time.
So if I authorize a payment at 9:00 a.m., my passenger is just sitting on the bench waiting for the 5:00 p.m. bus.
Exactly, just sitting there. Once the bus leaves, all those passengers travel together to the destination, the clearinghouse. That is efficient for moving a massive amount of data at once. It keeps the costs incredibly low.
Because you're sharing the ride.
Exactly. But if you miss the bus, if you arrive at 5:21 p.m., you wait for the next bus, which might not be until tomorrow morning. And once the bus leaves, it still takes time to get there, sort the passengers, and drop them off. That is why traditional payments take days.
Right. And in the ACH world, that bus ride can take hours or even days, depending on when you actually catch it. It's highly efficient, but it's sluggish.
Precisely. Now, contrast that with real-time gross settlement, or RTGS, which is what FedNow is. This isn't a bus. This is a fleet of teleporting taxis.
I love that. Teleporting taxis.
Each transaction is processed individually, line by line, the exact moment it is initiated. There is no waiting for a group. It is one-to-one processing.
And the gross settlement part of that acronym is key. That's an accounting term, but it has huge implications for the market.
It really does. In a netted system like the bus, you might have Bank A owing Bank B $10 million and Bank B owing Bank A $9 million.
Oh.
At the end of the day, the clearinghouse looks at the ledger and says, okay, Bank A, just send $1 million to Bank B and we are entirely square. That is net settlement.
Which saves a lot of actual cash movement.
It's very efficient for liquidity because you don't need to move the full $19 million back and forth. You only move the difference.
But in gross settlement?
In gross settlement, the 10 million moves and the 9 million moves. They move entirely independently and instantly. There is no netting. Every single transaction stands on its own.
Wow.
This means the liquidity requirements are totally different because you need the cash on hand to settle every single transaction as it happens. You can't rely on incoming funds later in the day to offset your outgoing funds right now.
That distinction is massive, and that leads us to the most critical concept here, finality. I feel like this is the word that lawyers and risk officers absolutely dream about.
They do. In the ACH world, or definitely with checks, there is this lingering uncertainty. You get a check, you deposit it, the number shows up in your account, you feel rich. But that money isn't really good yet.
It can bounce.
It can bounce. The sender can issue a stop payment. There's a clawback period. With ACH, a consumer can sometimes dispute a charge days later, claiming it was unauthorized, and the system literally pulls the money back out of your account.
Which is why businesses hate checks and even get nervous about ACH for brand new customers. The risk of insufficient funds or a stop payment order just hangs over the transaction for days. You are effectively extending credit to the payer until that clawback period fully expires.
Exactly. You're taking on credit risk without really intending to. With FedNow, when that payment clears, it is done. It's irrevocable.
Period.
There is no clawback.
Yeah.
Once the Fed debits the sender and credits the receiver, that is electronic cash. It is as final as handing someone a physical $100 bill. If you send it by mistake, you can politely ask for it back, but you cannot just reach into the system and take it back.
That changes the risk profile completely. If I'm a merchant and I get a FedNow payment, I can hand over the physical goods immediately. I don't have to wait 3 days to see if the check clears or if the ACH gets returned.
It accelerates commerce tremendously. But we do need to clarify the scope here for you listening. FedNow isn't an app you download on your phone. You don't go to the App Store and search for FedNow.
No, absolutely not. And please don't try. You'll probably just find some sketchy third-party news apps trying to steal your data.
Right. FedNow is infrastructure. It is the rails. It is the pipe buried deep underground. The apps, whether that is your bank's mobile app or a fintech wallet or a massive corporate ERP system, are the faucets that connect to the pipe.
Great analogy.
FedNow is available strictly to depository institutions, banks, credit unions that are eligible to hold accounts directly at the Federal Reserve.
So let's look at the cast of characters involved in a transaction. We have the participant.
That is the bank itself. The financial institution actively sending or receiving the money, they hold the master account at the Fed.
Then we have the correspondent. This is important for the smaller players, right? Because we have thousands of banks in this country.
We do. There are over 9,000 financial institutions in the U.S. Not all of them want to manage a direct master account connection to the Fed for this specific service 24/7.
It's expensive.
Extremely. It requires dedicated IT staff, 24/7 security operations, constant monitoring. So a smaller bank, let's call it Main Street Community Bank, might use a correspondent. This is usually a much larger bank that holds the master account at the Fed and handles the settlement on their behalf.
So the correspondent basically acts as the aggregator. They take the technical load off the little guy.
Correct. The Fed settles directly with the correspondent, and the correspondent manages a sub-ledger internally for Main Street Bank.
And then the service provider. These are the tech vendors.
The Jack Henrys, the Fizzerers, the FISs of the world. They provide the actual technical connection, the software interface that the bank uses to talk to the Fed's APIs. Most banks don't write their own code for this. They buy a module from their core provider.
And finally, the end customer. That's us. We're business.
Or a government agency paying out a tax refund. Correct. We are the ones initiating the payment through the bank's interface, but we never touch the FedNow network directly.
To really appreciate how revolutionary this is, we have to look at the history. We have been stuck in the era of ACH since the 1970s. What was the original problem ACH was trying to solve? Because today we complain about it being slow, but back then it was space-age technology.
It was entirely about volume, specifically paper volume. In the 60s and 70s, the volume of paper checks was growing so incredibly fast, it literally threatened to crush the banking system.
The physical weight of the paper.
Yes, the logistics were a total nightmare. Every single deck had to be physically transported, manually sorted, stamped. ACH was created to replace those paper checks with electronic batches. But get this. In the early days, the mechanism was store and forward. Banks would actually record transactions on magnetic tapes.
Actual physical reels of tape, like the ones you see spinning in old sci-fi movies.
Yes, and they would put those tapes in a locked bag and courier them, physically drive them, to the regional processing center.
So electronic transfer meant a guy in a van driving a magnetic tape across town.
In the beginning, yes. It was electronic, but not telecommunications. Obviously, it evolved over the decades. It moved from T+3 settlement to T+2, then finally T+1. We eventually got actual electronic transmission over phone lines and then the internet. And fairly recently, we got same-day ACH.
Same-day ACH was the industry's attempt to say, hey, we aren't dinosaurs. We can be fast, too.
It was a modernization effort to keep ACH relevant in a faster world. They introduced specific windows like 10:30 a.m., 2:45 p.m., and later settlement times, where if you got your file in, it would actually settle that exact same day.
But it is still a batch system.
It is still a bus. It's just a faster bus that runs a few more times a day. If you miss that 4:45 p.m. cutoff window, you are stuck sitting on the bench until tomorrow morning.
And while ACH was trying to speed up, the private sector made a huge move. Back in 2017, the clearinghouse launched RTP real-time payments.
This is a crucial part of the story. RTP was launched by the clearinghouse, which is a private entity owned by the biggest money center banks in the world. JP Morgan, Citi, Bank of America, Wells Fargo.
The heavyweights.
Right. And RTP is a true real-time system, very similar to FedNow in its mechanics. It runs 24/7, it settles instantly.
But there was a gap, a massive trust gap in the industry.
A very significant one. RTP captured the big banks immediately because, well, they literally owned it. But smaller community banks and credit unions looked at RTP and said, wait a minute, why would I join a network owned by my biggest competitors?
Makes sense.
Why would I willingly hand over all my transaction data, my customer flow data, to the rigorous oversight of the mega banks? There was immense hesitation. They wanted a neutral arbiter.
They wanted the Federal Reserve.
Exactly. The Fed is the regulator. The Fed is the central bank. There's a deep sense of safety and total neutrality there. So the Fed launched FedNow in July 2023 to provide a public option for instant payments. The stated goal was equitable access for all 9,000 plus financial institutions in the U.S., not just the big players at the top.
So now we have two competing real-time rails. You have private RTP and public FedNow. It's like having FedEx and the USPS. They do the exact same thing, but they're entirely different networks. But interestingly, they speak the exact same language.
They do. They both utilize the ISO 2022 messaging standard.
ISO 2022. This is the global Esperanto of finance. We hear this term all the time in banking conferences. Why does this actually matter to the average person or business owner listening to this deep dive?
Because in the old systems, like the original FedWire or ACH formats, the data you could actually send with the money was incredibly limited. You could send the dollar amount and maybe a few characters of text like invoice 123.
Very primitive.
It was exactly like sending a telegram. ISO 2022, on the other hand, allows for massive, rich data payloads. You can attach full invoices, detailed remittance information, complex references. The data travels seamlessly with the money.
Which is huge for automation. If I'm a business receiving $1 million, I don't just want the cash. I want to know exactly which 50 distinct invoices that $1 million pays off, so my accounting software can reconcile it instantly without a human being ever touching it.
Exactly. Infrastructure is destiny here. By adopting ISO 2022, FedNow isn't just faster, it's significantly smarter. It enables what we call straight-through processing.
STP.
Yes. The payment arrives, the ERP system reads the attached PAG, updates the internal ledger, and closes the invoice. Zero human intervention. No one matching spreadsheets.
Okay, let's get into the actual mechanics. I want to walk through the anatomy of a transaction. We call this the happy path, when everything goes exactly right. I'm sender. I open my banking app, I type in $500 to send to you, and I hit send. What exactly happens in the next few seconds?
The clock instantly starts. Your bank, the sender financial institution, constructs a digital message, specifically a PAX.008.
PAX.008. That's the code for a customer credit transfer.
Correct. PAX stands for Payments, Clearing, and Settlement. So your bank sends this Paxton 008 message directly to the FedNow service. It includes the amount, the sender details, the receiver details, and all that rich ISO data we just talked about.
And the FedNow computer receives it. What does it do next?
It validates immediately. It acts like a high-speed bouncer at a club. It checks the message format. Is it actually valid XML? It checks a digital signature. Is this actually from the bank it says it's from? And critically, it checks against the negative list to make sure we aren't dealing with a blocked entity or a sanctioned country.
If it passes all that validation, we hit the moment of truth. Settlement.
This is the critical moment. The Fed looks at the sender bank's master account and debits the funds. It simultaneously looks at the receiver bank's master account and credits the funds. This happens instantly within the Fed's internal ledger.
So the money has legally moved at the central bank level.
Yes. But the transaction isn't over yet. The Fed sends a payment advice message to the receiver bank.
And here's where it gets incredibly stressful for the IT guys. There is a timeout clock.
A very strict one. The entire process from the exact moment the sender bank hits go to the final confirmation has a hard timeout clock of 20 seconds.
20 seconds. That is the maximum.
That is the network max, but practically it's way tighter.
Yeah.
The receiver bank has a reserved response time. They can configure this themselves, usually between 1 to 5 seconds.
1 second.
So the Fed sends the message to the receiver bank, and that bank has literally 1 to 5 seconds to check the account number. Does it even exist? Check for fraud on their end. Is this suspicious activity? And say, yes, I accept, which is an ACTC code, or no, I reject an RJCT code.
If they take too long, what happens at second 6?
The transaction dies. The Fed rolls back the settlement. It credits the sender back, debits the receiver back, and sends a failure message to everyone. It effectively completely undoes the transaction as if it never happened.
So a bank's internal infrastructure has to be incredibly robust. You can't have some slow batch process running in the background that slows down your database queries. You need to answer in milliseconds.
It forces a complete ground-up upgrade of the banking tech stack. You absolutely cannot run a 1980s mainframe architecture and expect to thrive in a 5-second response window. This is exactly why you see banks aggressively moving to the cloud and upgrading their core banking systems.
Now let's talk about the nightmare scenario. We call this liquidity management. In the old world, the Fed wire system, the big wire system for massive institutional payments, closes. ACH closes. They have set operating hours. But FedNow never closes.
That is the 24/7 problem. FedWire generally closes around 7:40 p.m. Eastern Time. On weekends and holidays, it's closed entirely. But FedNow is running. It consumes liquidity constantly, 24/7.
So imagine it is 3:00 a.m. on a Sunday. I am a bank treasurer. My customers, maybe they're gig workers, maybe they're crypto traders cashing out or sending money out via FedNow. Every single time they send money, my master account at the Fed gets debited.
Correct. Your balance is actively draining while you are asleep.
What happens if I literally run out of cash in that master account at 3:00 a.m. on a Sunday?
The payments start rejecting outright. And that is a reputation disaster. If your retail customers try to send money to buy groceries and it fails because you, the bank, are out of liquidity, you are effectively insolvent in the eyes of the network at that exact moment.
Yeah.
You are failing to meet your daily obligations.
But the main window to get more cash FedWire is closed. I can't call the Fed and ask for a wire transfer on Sunday morning.
This was the single biggest technical hurdle to solving the 24/7 puzzle. The solution they built is something called LMT liquidity management transfers.
Break that down for us.
LMT utilizes a specific dedicated message type, a PAX .009. It allows banks to move bulk liquidity between master accounts even when the main FedWire system is completely closed.
So it's basically a backdoor for the banks.
It is a special high-speed service lane just for them. It supports massive transfers between banks or between a bank and a correspondent, or even to funding agents for private sector systems.
But there are strict rules. You can't just use this PAX .009 for everyday customer payments.
No. Strictly for bank-to-bank liquidity.
Oh.
And it operates primarily during those off hours, like 7:00 p.m. to 7:00 a.m. Eastern on weekdays, and 24 hours straight on weekends and holidays. It is the absolute lifeline. If you are a treasurer at a bank, you used to be able to go home on Friday afternoon, project your cash needs for the weekend based on historical data, and relax. Now, you need a completely automated mechanism to fund that account at 4 a.m. on Saturday if unexpected outflows exceed your projection.
It changes the entire job description of a bank treasurer from being a high-level strategist to an on-call firefighter if they aren't fully automated.
Or, if they refuse to automate, it forces them to hold massive amounts of sleep-well-at-night cash, just piles of excess reserves sitting in the account doing nothing.
Which is terrible for the business.
Very inefficient for their balance sheet because that cash isn't earning a high yield or being lent out to generate revenue. It's just sitting there as a buffer.
This liquidity issue extends to the private sector too, right? RTP has a joint account at the Fed.
Yes, the RTP system operates on a pre-funded model. All participants hold reserves in a massive joint account at the New York Fed. FedNow's LMT capability actually allows banks to top up that joint RTP account on the weekend. So ironically, the Fed's new public system helps keep its private competitor, RTP, perfectly liquid.
That's fascinating.
It creates a very robust, deeply interconnected safety net for the whole financial system.
Let's look deeper into the messaging ecosystem itself. We mentioned PAX messages, but the ISO 2022 standard has other distinct categories: PAIN and CAMPed.
It sounds like a terrible hospital visit, PAIN and PAX, but it is just the naming convention. PAX is payments clearing and settlement. That's the actual money moving. PAIN is payment initiation. That's the request or the instruction from the customer. And CAMPed is cash management, which handles reporting, balances, and notifications.
I want to focus heavily on a specific PAIN message because I think it is an absolute game changer for the business model of banking. The request for payment, or RFP, message type PAIN .013.
This is fascinating, truly. In the old ACH world, if a utility company wants to bill you, they typically use a debit pull. You give them your routing and account number once, and they literally reach into your account and pull the money out on the due date.
Which is terrifying if you don't have the funds in there that day. You get hit with massive overdraft fees or the payment bounces and your power gets shut off.
Right. It's high anxiety. RFP entirely flips the model. It turns a debit pull into a credit push.
A credit push.
Yes. The utility company sends a digital invoice, a PAIN .013 message, directly to your bank app. It pops up on your phone screen as a notification. Electric company requests $150. Pay.
And I have to physically hit yes.
You authorize it in real time. You push the money to them. This matters tremendously because it gives control entirely back to the payer. It completely reduces the risk of returns for the biller because you physically can't push money you don't have. The bank checks your available balance before it ever sends the PAX message.
So for the biller, it basically eliminates the insufficient funds risk, which saves them a fortune in return fees. For the consumer, it completely eliminates the surprise overdraft risk.
Exactly. It creates a much cleaner, highly predictable flow of funds. It's a vastly better user experience for everyone involved, but there's a catch. It requires the banks to actually support that message type.
Right. They have to build the interface.
Not all banks are ready to receive RFPs yet. It requires significant updates to their mobile apps, their user interfaces, and their back-end processing systems.
Let's touch on the administrative side of things. How does a bank tell the Fed, hey, I'm offline for maintenance, don't send me anything right now?
That is handled by the ADMI .004 message. It is a broadcast message. A participant uses it to officially sign off or sign back onto the network. If you were doing scheduled server maintenance, you send a broadcast saying, I'm signing off. The Fed immediately then rejects any incoming payments destined for you until you send another message signing back on.
Which is smart.
It prevents messages from falling into a digital black hole if a bank has a system outage or is rebooting servers.
And there is a ping function, too.
Yes, also handled under ADMI .004. You can ping the Fed network just to check connectivity. It's basic network hygiene, like pinging a router, but absolutely crucial when millions of dollars are moving every second.
What about fraud? We really need to talk about the speed. If I steal someone's login credentials and send a FedNow payment, that money's gone in seconds. How do the banks mitigate that risk?
It is absolutely the double-edged sword of finality. Speed kills float, but it also drastically reduces the window for fraud detection. You can't catch it the next morning. The FedNow service has built-in tools at the network level. Banks can upload negative lists, which are essentially lists of known bad actors, suspicious account numbers, or prohibited countries.
So the Fed checks the list automatically before processing the settlement?
Yes, instantly. There are also velocity limits. A bank can set specific thresholds, say, do not allow more than $1 million to leave this specific corporate account in a 1-hour window. If a transaction hits that limit, the network system blocks it. This is designed to stop account draining attacks where a hacker tries to empty an account in seconds.
There is also a very interesting response code we found called ACWP, accept without posting. This sounds like some sort of regulatory limbo.
It is exactly a holding pattern. Let's say a bank receives an incoming payment for a retail customer, but something looks just a little bit off. Maybe the amount is unusually high, or it triggers a soft anti-money laundering alert in their internal software.
Right.
They don't want to reject it immediately because false positives happen all the time, and rejecting good money makes customers angry. But they certainly aren't ready to show the money as available in the customer's account.
So they basically tell the Fed, I'll take it, but I'm keeping it locked in the back room for a minute.
Exactly. Except without posting. The interbank settlement happens. The banks have officially swapped the funds at the Fed, but the beneficiary bank holds the funds in an internal suspense account while they run extra manual compliance checks. If it clears the compliance team, they post it to the customer. If not, they have to formally initiate a return message.
That seems like an absolutely critical safety valve for compliance officers who are sitting there terrified of that 20-second timeout clock.
It gives them a little breathing room, yes. It perfectly balances the network's need for speed with the bank's strict legal need for security.
Let's talk about the accounting cycle, because the Fed has a distinct end of day, right?
Yes. Even though the payment service itself runs 24/7, never stops, the accounting books have to close sometime to calculate reserves. The FedNow cycle day typically rolls over at 7:00 p.m. Eastern Time.
So if I send a payment at 7:05 p.m. on a Tuesday,
that is technically a Wednesday transaction in the eyes of the Fed's accounting system.
That matters heavily for daily interest calculations and regulatory reserve requirements.
It does. And reconciliation happens via specialized reports like the AATR, the Account Activity Totals Report. Banks get this generated report to balance their complex internal ledgers against what the Fed says actually happened over the last 24 hours. It's the daily scorecard.
Let's shift gears to the investor context. We are talk tickers. We care about the money, the margins, the strategy. How does all this plumbing change the competitive landscape?
The battle here is entirely for primacy. For years, fintechs, your Venmos, your Squares, your PayPals have completely owned the user interface. They basically disintermediated the legacy banks. You open Venmo, not your Chase app, to pay a friend for dinner.
Mostly because the bank apps were clunky, slow, and P2P transfers took 3 days.
FedNow changes that. It allows banks to natively embed instant final payments directly into their own apps. It is a massive, coordinated move to reclaim the primary customer relationship. If your main bank app can do exactly what Venmo does, but the money stays in your FDIC-insured bank account and actually earns interest up until the very millisecond you hit send, why do you need the third-party wallet?
That poses a huge existential risk to the float model of some of these major fintechs. They rely on holding your cash.
Potentially, yes.
Yeah.
But there's also a very real cost structure to consider. FedNow has a per-transaction cost. Currently, it is a cost recovery model for the Fed, meaning they just charge enough to keep the servers running,
Right.
But banks have to make a strategic decision.
Right.
Do we absorb this transaction cost to keep the customer happy and loyal, or do we charge a premium fee for instant transfer?
We are seeing wildly different strategies out there right now. Some charge a percentage, for instance. Some make it completely free as a loss leader.
And that leads naturally to the ultimate question we hear from investors. Will FedNow eventually replace ACH?
The million-dollar question, is ACH completely dead?
The short answer is no. Absolutely not. They will coexist for a very long time. It is all about specific use cases.
Right. Because if I am running a payroll file for 10,000 corporate employees,
You do not want to use FedNow for that. Why? First, cost. ACH is incredibly, almost practically free for massive bulk files. Second, system complexity. Do you really need your Treasury workstation to initiate 10,000 individual real-time settlements that hit your master account one by one over the span of 10 seconds?
that sounds chaotic.
No. You want to send one clean batch file on Wednesday to systematically pay everyone on Friday morning. It is highly predictable and low stress.
But if I'm a gig worker,
If you are an Uber driver and you just finished a grueling 12-hour shift and you desperately need to buy gas to get home, you want FedNow. You want that money instantly. Or if a business needs to pay a critical supplier today, right now, to get a shipment released from customs, that is the true urgent use case.
so ACH remains for bulk, highly predictable, low-cost flows. FedNow takes over the urgent, time-sensitive, high-value flows.
Exactly. Also, you have to remember, ACH is deeply, deeply ingrained in corporate ERP systems. Ripping and replacing those connections is incredibly expensive. You don't tear out a legacy payroll system that works perfectly well just to save a few hours of float. unless your employees actively demand it.
What about the interoperability problem? If I bank with a tiny credit union that only uses FedNow, and you bank with a giant money center bank that is only connected to RTP.
That is the major friction point in the market right now. Currently, FedNow and RTP are absolutely not interoperable. You cannot send a payment from a FedNow-only bank to an RTP-only bank directly without building a custom bridge.
That seems like a massive flaw for a national payment system. It's the VHS versus Betamax problem all over again.
It is a serious fragmentation issue. It dramatically slows down adoption because smaller banks just sit on the sidelines waiting to see if they really need to spend the money to connect to both networks.
Yeah.
The Fed is aggressively pushing for eventual interoperability, but technically, bridging two distinct real-time 20-second timeout systems is incredibly complex.
I can imagine.
It will likely be solved eventually by third-party processors routing the messages intelligently in the background, but we simply aren't there yet.
Let's talk about the liquidity trade for the bank analysts listening. If I'm looking at a regional bank's balance sheet this quarter, what fundamentally changes?
You need to watch excess reserves very closely. In an instant payment world, liquidity outflows can be extremely volatile and unpredictable. A bank might see a sudden massive surge of outflows at 8:00 p.m. on a Saturday because of a local event or a crypto market crash.
And the interbank lending markets are closed.
They cannot rely on borrowing from the repo market until Monday morning. So to survive, they need to hold much more cash on hand idle, uninvested cash in their master account at the Fed.
Which is a direct drag on their return on equity, their ROE.
It absolutely can be. It changes the fundamental efficiency of the banking balance sheet. They have to buffer against 24/7 volatility, which means less money working in the broader economy.
This brings us to what we call the one question. If you are an institutional investor talking to a bank management team on an earnings call, or if you are a CFO of a mid-sized company looking at your own treasury operations, what is the one single question you must ask?
The question is simply this. Does your institution's liquidity management framework have a fully automated mechanism to fund the master account at 4 a.m. on a Saturday? Or are you still relying on Friday afternoon's manual projections?
That is the killer question. Why does it matter so much?
Because in an instant payment world, a catastrophic liquidity crunch doesn't happen over a few days. It happens in seconds. If you can't settle a payment, you're failing your customers instantly. If you're relying on a Friday Excel spreadsheet for a Saturday reality, you are driving completely blind on a highway where everyone else is doing 100 miles an hour.
Powerful stuff. Let's wrap this deep dive up with the key takeaways for you all to remember.
Takeaway 1, speed kills float. The legacy era of playing the float, writing a check and hoping it takes 3 days to clear is ending. Money moves instantly now. Working capital management must become real time. You just can't write a check on Friday hoping it clears on Tuesday anymore.
Takeaway 2, it is a credit push world. The structural shift from ACH debit pulls to FedNow credit pushes via request for payment completely shifts power back to the payer and drastically reduces return risk for businesses. It is fundamentally a safer way to get paid.
And takeaway 3, infrastructure is destiny. The mandatory adoption of ISO 2022 allows for incredibly data-rich payments. The real institutional value isn't actually just the speed, it is the automation. It is the detailed invoice permanently attached to the money that allows the corporate accounting software to completely reconcile itself. That is the massive productivity unlock for the next decade.
Incredible. We went from literally driving magnetic tapes in vans like donkey carts to teleporting taxes in 60 minutes.
It really is a brave new world for financial plumbing.
I want to leave you with a final thought to mull over. If we now have instant, irrevocable settlement combined with rich, programmable ISO data payloads, how long until we see true smart contracts executing entirely on central bank rails? Imagine an escrow account that automatically releases funds the exact millisecond a digitized shipping manifest is signed at a port with zero human oversight. The plumbing is finally laid. Now we get to see what people build on top of it. This has been Talk-A-Tickers. Keep your eyes on the plumbing.
See you next time.